There's an old saying, cash is king. But when it comes to investing, the real king is cash flow. In this video, we'll break down how to analyze a company's cash flow statement, one of the most important financial documents for investors. Drawing from my experience as an investment analyst at a large investment firm, I'll help you understand exactly what to look for when evaluating a company. Whether you're a beginner, just starting your investing journey, or a seasoned investor, I guarantee that by the end of this video, you'll walk away with valuable insights you can immediately apply to your own research process. So, let's get started. A cash flow statement, also known as the statement of cash flows, is a financial document that summarizes how much cash enters and exits a company. Think of it as a record of all the money flowing in and out of the business. A positive number means cash is coming in, while a negative number means cash is going out. This statement helps you, as an investor, understand how well a company's operations are performing, where its money comes from, and how it's being spent. Ultimately, the cash flow statement reveals how much cash a company is generating, and that's crucial, because a company's long-term value and stock price are determined by how much cash it can produce. Simply put, the more cash a company generates, the more valuable its stock becomes. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. The operating section covers cash generated or used in a company's core business, things like sales receipts, supplier payments, wages, rent, and taxes. The investing section reflects cash used for investments in property, equipment, or acquisitions. It's usually negative for growing companies because they spend cash to expand operations. The financing section shows how a company raises and repays money, whether through debt, issuing shares, paying dividends, or repurchasing stock. When a company borrows money or issues bonds, it's a cash inflow. When it repays debt or pays dividends, it's a cash outflow. To see how this works in practice, we'll use Coca-Cola as an example. If you've ever wanted to research a company, like Coca-Cola, but didn't know where to start, I recommend checking out the Investing App Quarter, which sponsors this video. It's a free tool I personally use to listen to earnings calls and read call transcripts. You can find the download link in the description. It's a huge time saver and makes investment research much easier. Now, let's break down Coca-Cola's cash flow statement line by line. The first line is net income, which represents the company's profit. It's calculated on the income statement, not the cash flow statement. I've made a full video explaining how to analyze an income statement like a hedge fund analyst, which you can check out later for more detail. Next, we move to operating cash flow, which is calculated under the operating activities section. Between net income and operating cash flow, several key adjustments are made. One of the biggest is depreciation and amortization, a non-expense that reflects the gradual reduction in value of assets over time. For example, if Coca-Cola buys equipment worth $1,000 with a 5-year useful life, it records $200 in depreciation each year. Even though the company spent the $1,000 up front, no additional cash leaves the business annually, so this expense is added back when calculating cash flow. Another important adjustment is stock-based compensation, where companies pay employees with shares instead of cash, a common practice in tech firms. For instance, an employee at Facebook might earn $150,000 in salary and $50,000 in stock. Since no cash leaves the company for the stock portion, this too is added back to net income. Coca-Cola's stock-based compensation is relatively small, but for tech companies, it can be a major factor. Facebook's was $6.5 billion in 2020. We also look at net change in operating assets and liabilities, or working capital, which represents short-term cash used to run the business. Growing companies often have negative working capital because they need more cash to fund operations, while mature companies like Coca-Cola may fluctuate between positive and negative depending on the year. All of these items build up to net cash provided by operating activities or cash flow from operations, which shows how much money the company's core business generates. This figure is essential because it's used to calculate free cash flow. FCF, arguably the most important metric for valuing a company. The value of any investment, whether it's a stock, building, or small business, depends on the cash flow it can generate over time. To calculate free cash flow, we start with cash flow from operations and subtract capital expenditures, cash spent on acquiring, upgrading, or maintaining assets like property, plants, or equipment. CapEx helps companies grow or sustain their operations. For example, if Coca-Cola expands a factory to meet higher demand, that spending is considered a capital expenditure. This figure can be found in the investing activities section of the cash flow statement under purchases of property, plant, and equipment. To calculate net CapEx, we take that number, which was minus $1,177 in 2020, and add any proceeds from disposal of property, plant, and equipment to it. This gives us the foundation for understanding a company's cash flow. one of the most powerful tools for analyzing a business's true financial health. The 1,177 number is important because it helps us determine the true amount Coca-Cola spent on capital expenditures, CapEx, in any given year. For 2020, we take the negative 1,177 for purchases of property, plant, and equipment, and add back 189 for the disposal of PPE, which gives us a net CapEx of negative 9. To calculate free cash flow, we take the company's cash from operations of 9,844 for 2020 and subtract the net CapEx of 988, leaving us with 8,856. Since these numbers are in millions, that means Coca-Cola generated $8.8 billion in free cash flow in 2020. Remember how I said at the beginning of the video that cash flow is king? This is why. Free cash flow is my favorite metric when analyzing a company because it represents the amount of money that can actually be paid out to shareholders. With this money, a company can pay dividends, buy back stock, or pay down debt, all of which are great for investors. Now that we have free cash flow, let's look at a couple of useful metrics to deepen our analysis. One of my favorites is the free cash flow yield, which is calculated by dividing a company's free cash flow by its market capitalization. The result is a percentage that helps you compare companies regardless of size. In Coca-Cola's case, the free cash flow yield has hovered around 3 to 4% in recent years, and generally, the higher this percentage, the better. Another valuable metric is CapEx as a percentage of sales, which measures a company's capital intensity, basically, how much it must spend to maintain and grow operations. It's calculated by dividing the net CapEx by total revenue. For Coca-Cola, this figure is around 3% of sales each year. This number varies widely by industry since some sectors, like railroads, are far more asset-intensive than others, such as software. Moving on to the investing activity section of the cash flow statement, this part includes items such as purchases and proceeds of investments. When companies have excess cash, they often invest it in short-term low-risk assets like government bonds to earn some return rather than letting it sit idle. You'll also find acquisitions and disposals of businesses here. It's common for companies to acquire others to expand geographically or diversify their product lines. Coca-Cola, for example, spent $5.5 billion in 2019 on acquisitions, including buying the coffee brand Costa and an ownership stake in Chi, a Nigerian producer of dairy, juice, and tea beverages. As an investor, it's essential to check if a company is spending heavily on acquisitions because it can reveal strategic shifts or growth ambitions. Likewise, companies sometimes sell off divisions or brands that no longer align with their long-term goals, and these sales are reflected in the proceeds from disposals line. Next is the financing activity section, which covers how a company raises and returns capital. One key line item here is purchases of stock for treasury, which shows how much cash a company spends on share repurchases. As a long-term investor, I love seeing businesses that can both invest in growth and buy back their own shares. Share repurchases are powerful because they reduce the number of shares outstanding, which automatically boosts earnings per share (EPS). For example, if a company earns 100 with 100 shares outstanding, its EPS is $1. If it repurchases 10 shares, reducing the count to 90, the EPS becomes $1. An 11% increase without any actual growth in earnings. A real-world example of this power is seen with Coca-Cola and Warren Buffett. Buffett's company, Berkshire Hathaway, is Coca-Cola's largest shareholder, currently owning 9.3% of the company. When Buffett first invested, his stake was just 6.2%. But because Coca-Cola has repurchased shares over time, his ownership increased by 50% without him buying a single additional share. This perfectly demonstrates how share repurchases reward long-term investors. To get a complete picture of buybacks, we also need to consider issuances of stock, which represent new shares the company issues. Issuances increase the share count, the opposite of repurchases. To find out how much a company truly spends on repurchases, we subtract the cash received from issuing shares from the cash spent on buying them back. In Coca-Cola's case, this shows that in 2020, the company didn't actually spend net cash on repurchasing shares because the proceeds from issuing new shares outweighed the repurchases. This is why the total number of shares outstanding increased that year. Finally, let's talk about dividends. Coca-Cola is well known for paying substantial dividends to its shareholders, over $7 billion in 2020 alone. Investors love to see dividends rising consistently, which Coca-Cola has achieved, going from $6 billion in 2018 to $6.8 billion in 2019 and over $7 billion in 2020. If a company starts cutting or freezing dividends, it's often seen as a red flag, signaling potential trouble. One useful analysis is to add up total dividends and share repurchases, then divide that total by the company's free cash flow. The result shows what percentage of cash flow is being returned to shareholders. If that percentage exceeds 100%, it's unsustainable over time, as the company would need to borrow or dip into reserves to maintain payouts. However, seeing this for a single year like Coca-Cola in 2018 isn't necessarily alarming. So there you have it, a full breakdown of how to read and analyze a cash flow statement, from operations to investing and financing. If you enjoyed this video, make sure to give it a big like and subscribe to Investor Center. My mission is to make you a smarter, more confident investor by studying how the world's greatest investors think and act. Share your thoughts in the comments below, and stay tuned for my next video, where I'll show you how to analyze a balance sheet like a hedge fund analyst. See you next time.